This video will explain how to account for the issuance of treasury stock using the cost method. A company may buy back shares from existing shareholders for a number of reasons. Shares that have been repurchased are called treasury stock. The purchase of treasury stock is typically accounted for by the cost method. Under this method, acquisition of the treasury stock are accounted for by debiting treasury stock and crediting cash for the cost of the shares purchased. Treasury stock is a contra equity item. It is not reported as an asset, but rather it is subtracted from or reduces stockholders' equity. Treasury stock will decrease by the same amount when the company later sells the shares. To illustrate treasury stock, let's assume the stockholders' equity section for this company has 100,000 shares of $5 par value common stock outstanding and retained earnings of $100,000. So stockholders' equity totals $600,000. Let's assume on February 1st, this company acquires 4,000 shares of its stock at $8 per share. The entry results in an increase or a debit to treasury stock for the cost of the shares purchased, or $32,000, and a decrease or a credit to cash for the same amount. The paid-in capital account common stock would not be affected by this transaction. Companies show treasury stock as a deduction from total paid-in capital and retained earnings in the stockholders' equity section of the balance sheet. The acquisition of treasury stock reduces stockholders' equity. The presence of treasury shares will cause a difference between the number of shares issued and the number of shares outstanding. The balance sheet discloses the number of shares issued, in this example 100,000, as well as the number in treasury, which is 4,000 shares. The difference between these two numbers represents the outstanding shares, or 96,000. The term outstanding shares or outstanding stock refers to the total number of shares of issued stock that are currently being held by stockholders.